Beneath the veneer of lighter trading volumes, thanks to the holiday season, the World Cup, and perhaps ample confusion over 2023 and its prospects, there's plenty of movement bubbling under the surface in markets. We have seen heavy activity as well as inflows into key segments of the ETF market that have bucked the trading slowdown, including ETFs tied to China, of all places, and the emerging markets overall, like the Crane Shares China Internet ETF or the KWEB, ticker KWEB. Also, single stock ETFs that allow investors to make either leveraged or inverse bets on big cap technology names like Tesla, amongst others. So joining us now is Tom Lydon, the vice chairman of VettaFi, and also Will Ryan, the founder and CEO of Granite Shares. Gentlemen, thanks to both of you for joining us here on the ETF Edge. I mean, Tom, maybe we'll start with you with the bigger picture macro side of things. Talk to us about some of these hot trends in the ETF business right now. What exactly are we learning about investor appetite for risk, the tolerance for it, as we get ready to close out this year, 2022, and go on to next year, 2023?
Yeah, Dom, you mentioned China, and all eyes are on China. The Chinese government's on a mission. They're looking for a rebound, so they're supporting real estate in a big way. The coronavirus protocols have been a little bit lax, which is great as more people are coming back. They're going to stores, they're going to casinos. Real estate prices are back. They're encouraging people to buy properties. Also, we know that China does not want to disconnect from the global capital markets. So all the saber rattling that we've seen back and forth with the SEC looking to maybe delist Chinese stocks in the next couple of years, probably not going to happen. So is this a buying opportunity? Absolutely. There are valuations that we haven't seen in decades. And when you mention companies like, or ETFs like KWEB, the Crane Shares China Internet ETF, down 80% since the spring of last year. However, just in the last couple of months, it's up 50% off its lows. So there are definitely opportunities there. When you look at valuations, many are saying generational opportunities. But also there are other areas like fixed income. We saw negative flows in fixed income earlier in the year. However, the Fed has been a little bit more transparent. We've also seen redemptions out of fixed income mutual funds into ETFs, as tax loss harvesting has been the year for that, for sure, both on the equity and on the fixed income side. And, you know, a couple other areas, we're going to talk a little bit about commodities. We've actually seen metals and miners really kick in the last couple of months. And I can't help but mention Cathie Wood. We haven't talked a lot about her lately. Her ETF ARC is down over 70% off the highs. But if you liked it for all the reasons you liked it a year and a half ago, and you had a 5% allocation, why wouldn't you think about nibbling away with the great valuations that we have today?
All right, so the depressed values is certainly something a lot of folks are out there watching. I mean, Will, I'll turn to you here. Are there any other key trends that have stood out to you? I mean, you run an ETF business. We've seen a decisive shift away from some of these growth and tech, media, telecom type stocks towards almost value-oriented, dividend-paying, dividend-yielding type assets in that mad dash for yield. Although I will point out that I guess even risk-free treasuries are giving you anywhere from 3.5% to 4.5% right now. What happens to that trade, that value trade, that yield trade, so to speak?
Well, like you say, I think people focus on what worked this year, and that was really commodities as one of the few places where people made money, and that will continue in my mind next year. The other thing you just mentioned has also been a big trend this year, which is income or yield products really coming back to the fore, as opposed to being sort of overshadowed for the last few years, particularly by some of the growth investments. Now, we're in a situation where people are looking to prioritize cash flows, prioritize income, and really adopt a much more of a defensive posture. And so that's where income products come in. And I think income will continue to do well, even though obviously interest rates are rising and have been rising quickly this year. I still think that more value-orientated play, people looking for high income products will continue.
Will, could I follow up on that just really briefly? I mean, there are a number of different places within the ETF market overall where people do try to find that hunt for yield, right? That income type play. We heard Tom mention some of those fixed income plays that are kind of coming to the forefront right now. I wonder, have you seen anything in your mind trend-wise with regard to certain exact parts of the market that are going to be hotter than others when it comes to some of that income trade? Is it going to be more in real estate investment trusts? Is it going to be towards some of these more dividend-type paying names like the aristocrats? Is it going to be certain energy parts of the market in anticipation of spending? I got to figure there's a ton of things out there, catalyst-wise, that could drive that income trade.
Yeah, I think to kind of parse that a little bit more, you see interest, and we've seen this over a number of years, but we'll continue to see interest in companies, high-quality companies that have a track record, or can demonstrate a track record of increasing their dividend over time. That becomes more attractive. We've also seen a lot of interest in a space that we operate, which is in the pass-through security sector of the market. So providing income from places that link to hard assets or real assets that, again, have a more of an inflation-related spin on the income. So that's things like master limited partnerships, or MLPs, REITs, which deal with physical property, not mortgages. And so I think this is an interesting area of the market where we're going to see more interest next year, that this real asset-orientated income.
All right, Tom, it's been a huge year. I mean, a big one for ETF flows. The second best year on record now, with north of $600 billion that we've seen. Can we expect to see the industry maintain this kind of momentum heading into next year? And if so, hypothetically, what sectors stand to benefit the most from that investor money that's been pouring into exchange-traded funds?
Right, Dom. I mean, look, when you look at 30,000 feet, mutual fund companies are continuing to have a tough time holding on to assets. Again, nothing against mutual funds. It's all about a choice. It's all about a wrapper. But when you look at the vehicle of choice, it really has been ETFs for a variety of reasons. We touched on tax loss harvesting. That has shown a lot of money coming out of mutual funds into ETFs. And then if you look at the big players, the big asset managers, you've got companies like AllianceBernstein, Morgan Stanley, Capital Group, Neuberger Berman, that traditionally were in the separate account side or the mutual fund side, that are now coming into the ETF space. And companies like Dimensional Fund Advisors that have converted their mutual funds into ETFs, I think we're going to see a lot more of that as well. There are also, as you mentioned, a lot of choices. When you look at the options overlay strategies in some of these equity-based ETFs that not only replicate the equity markets and provide a little bit of a buffer, but they also provide some pretty strong yields. Companies like JP Morgan with their JEPI product, or Nationwide with Newsy, NUSI. If you can replicate an index while at the same time getting a 7, 8, 9% yield, it's pretty attractive.
All right, so those income instruments, again, continue to be in focus here. And, of course, the tax issues surrounding ETFs versus mutual funds, the timing at which you can take them, the optionality that ETFs give you, maybe one of the reasons why they're becoming more attractive versus mutual funds in that regard.